Yes, hello. My name is Dmitry Pugachevsky. I'm Director of Research with Quantifi. Quantifi is a software provider. We are building systems for managing counterparty and market risks. And today we'll share some of our findings which we obtained using our system. Aurelie?
Yeah. Hello everyone, and thank you for joining this webinar. My name is Aurélie Civilio and I'm Senior Consultant at Risk Dynamics. I'm in charge of the development of knowledge for advisory and counterparty credit risk, and I'm really pleased to present this topic with Dimitri today. So first, let's have a look on the agenda. We would like first to make a point on the new regulation with respect to the counterparty risk and present an overview of related regulatory methodologies. After that, we would like to show you what are the impacts of this new regulation and the minimum regulatory capital for specific businesses. Then we will provide an overview of the market status with respect to the implementation of the new regulation on counterparty risk by presenting the main outcomes of our survey that we ran last summer. Finally, we would like to conclude by presenting the opportunities and challenges of the market for the short term and let some space for a Q&A session. So as you all know, the financial crisis in 2008 demonstrated that capital requirements within Basel II were insufficient, in particular with respect to counterparty risk. It appears that 2/3 of the counterparty credit losses in the financial crisis were suffered not as a result of actual default of the counterparty, but because credit market volatility negatively impacted banks' earnings. So in response to this, Basel III introduced in its capital requirement a new capital charge for Credit Valuation Adjustment known as CVA. It will be in application as from the 1st of January 2014. The purpose of this charge is to improve banks' resilience against potential mark-to-market losses that are associated with the deterioration in the creditworthiness of the counterparties. In terms of scope of application, the CVA charge applies only to non-clear trades as exposures towards CCP, so central counterparties, are exempted for the CVA charge. So this new capital regulation requires more widespread attention as it significantly increases the required capital for OTC derivative, and it consequently drives a significant change in the sector of trading activity. So within the next slide, we summarize the regulatory methodologies for calculating the capital charge for counterparty credit risk. So first of all, the counterparty credit risk capital charge is split into two components. You have a CCR default charge covering default and migration of counterparties, and a CCR market charge covering market prices volatility. For example, it covers the volatility of the credit spread curve of the counterparty of a derivative, or the volatility of the exposure and the volatility of the value of the collateral due to market movements. So as you can see, the default and the market charges are simply added together without taking into account any compensation for the connection that you can have between spreads and ratings. It is then a quite conservative approach. Now, more specifically, if we consider first the default charge, since Basel II, the regulator offers three methodologies to the banks for computing their exposure at default. You have the current exposure method that we denoted by CEM, the standardized method denoted as SM, and the internal model method denoted by IMM. So briefly, in few words, the CEM will calculate the exposure at default by using a simplified approach, which is based on the current mark-to-market of your derivative plus the potential future exposure add-on. This potential future exposure add-on estimates, in fact, the potential change in the derivatives market value at a future date, given the replacement or the closeout of the contract. One of the recognized drawbacks of this method is that it understates the benefit of netting and of collateral. Moreover, it has been criticized for not reflecting fully the volatilities of the recent stress periods. Now a few words on the standard method. The standard method is an intermediate approach between the CEM and the IAM. Within this method, the exposure default is calculated as the sum of the net exposure for each hedging set. And by hedging set, it means a set of position with common market risk factors. So for example, with the same interest rates in a particular currency or equity issuer. One of the recognized drawbacks of the standardized method is that its definition of hedging set leads to operational complexity and makes it difficult to implement. Finally, the third method, the IMM method, is a more sophisticated method than the CM and the standardized method. It is based on the effective expected positive exposure calculated using a Monte Carlo model. One of the advantages of this methodology is that it allows for future collateral, and it's generally less conservative than the two previous ones. So as you can already see, the framework of the CCR default charge is quite complex, and it's even more difficult to put in place in practice, in particular due to the complexity of collateral and hedging aspects. Partly for this reason, the BCBS published for consultation a new methods for default CCR charge, replacing both the CM and the standardized methods. They suggest to use the non-internal model method, denoted as NIMM, as described here in this slide. Broadly, on this method, we can say that it has a general structure of that it has a similar structure as the CEM method. So it's a current mark-to-market plus potential future exposure add-on. But the methodologies underneath are very different, in particular in the application of the collateral and the offsetting rules that will result to a lower exposure at default. Some important advantages of this NIMM method with respect to the CMM are that the INM is calibrated on a stress period, and it recognizes the benefits of collateral, and it is more reflective of legal netting arrangements. So with this new method, in fact, the regulator aims at improving significantly the risk sensitivity of the capital framework without creating undue complexity. Now that we explain the first component of the CCR capital charge, let's talk now about the CCR market charge, so on the charge on the CVA. For this new charge, the regulator proposes two methods for calculating the CVA capital charge: a standardized approach, which can be interpreted as a 99% confidence interval for a portfolio of normally distributed assets, and an advanced method, for which Basel requires to calculate a 10-day 99% value at risk of the CVA for the current year, added to that the CVA on the value at risk on the stress period. So finally, the total CCR capital charge is a result of a sum of both methods, and concretely, banks with an IMM approval and a market risk internal model approval can combine the internal method model for CCR default and the advanced CVA capital charge. In all other cases, you can just use the standardized CVA methods. Now that we have a good overview on the regulation and on its methodologies for calculating the CCR charge, I will now give the floor to Dimitri. We will discuss the impact of the choice of methods on the different types of businesses.
Thank you, Aurelia. Okay, so Aurelia described in detail different types of calculation for both Basel II and Basel III. And together with Risk Dynamics, we decided to run some tests for different portfolio strategies. So we realized that portfolio strategies for counterparty credit risk management can vary substantially depending on the institution business model. And to capture these variations, we consider 3 different portfolios with different counterparty profiles, representing 3 different types of banks. So A is typical retail bank using interest rate swaps and some interest rate options to mitigate its interest rate gap between assets and liabilities. B is universal commercial bank, with still a significant activity on interest rate derivatives for ILM purposes, but also trading books to service SME and corporate clients via currency swaps and vanilla options. And C is an investment bank with limited vanilla interest rate or FX derivatives, but a significant amount of equity, exotic and structured derivatives products. Business is performed in multiple currency and trading is executed for clients and for proprietary purposes. Clients are mostly corporate, banks at any type of financial institution with low rating. According to these bank profiles, we introduced 3 portfolio strategies, retail, wholesale, and proprietary, and set up 3 portfolios with different numbers and credit quality of counterparties. And of course, constitution of 3 portfolios were also very different, but the total notional of each portfolio was 10 billion. We provided the following results. For default capital charges related to Basel II, we calculated charges according to CM and IMM methods, and for Basel III CVA capital charges, we calculated standardized CM, standardized IMM, and advanced. So basically, we performed all the calculations except for related to SM method, standardized methodology, in terms of Basel II, but as I already mentioned, this will be replaced anyway, and we expect NIMM methods to be somewhat close to CM. So these results we expect to be relevant even after NIMM will replace CM and SM. To produce result for IMM and for advanced CVA, we used full recalc Monte Carlo, and others it's just a simple formula which can be implemented in a spreadsheet. So this is base case where we just have all the capital charges for different strategies and for different types of calculation. So immediately, if we compare Basel II charges, these are 2 groups on the left, immediately one can see that IMM charges are much smaller than CM. And same one can say about advanced CVA methodology in comparison with standardized either CM or standardized IMM. So both for Basel II and for Basel III, implementing more complex, more sophisticated models and getting regulatory approvals basically pays off in terms of saving large amounts of capital. That's our first conclusion. Another conclusion is that the widely held opinion after Basel III was published was that Basel III capital charges are much bigger than Basel II. Basically people are talking about Basel III much more than Basel II, but Basel II capital charges, default capital charges are still significant, and in many cases, like for example, for retail CM, they are even bigger than Basel III capital charges. So basically you have to pay attention to both Basel II and Basel III, and further we will talk about combination of Basel II and Basel III. To see how total CCR capital charges perform during credit deterioration, we ran a widening scenario when credit spread doubles and when simultaneously all counterparties are downgraded 1 notch. For simplicity on this slide, we only graph proprietary strategies, and we graph a combined CM, Basel II and Basel III. So this is total capital charges coming from counterparty risk. And immediately one can see that increase for IMM and advanced CVA is, in relative terms, is bigger than for two other methods. This increase is 56% versus 31 and 35 for two others. There is explanation why widening of spreads kind of is more punitive for this method, for more advanced method. These two methods in terms of standardized CVA, they depend only on rating, and when rating goes down one notch, it's not as big impact as widening of spread twice. But nevertheless, even in this kind of punitive scenario for this IMM and advanced CVA methodology, the combined results is still smaller than combined capital charges for two other methodologies. So it's still the best even in such kind of scenario which is more punitive for this methodology. Of course, when spread widen and when counterparties are downgraded, portfolio managers or risk officers or bank CEOs, they cannot do much about this, but we thought about one scenario when you can manage counterparty risk with basically changing profile of your portfolio, in this case by changing concentration of maturity. So what we proposed here is to increase my concentration around 5 years. Basically we halved distance from maturity of the swap to 5 years. If you had a 7-year swap, then we changed this maturity to 6. If you had 3-year swap, we changed this maturity to 4. So basically distance between, or difference between maturity and 5 years was decreased in half. And that we did for interest rate swap and cross-currency swap. For FX forwards and other FX instruments which are short-dated, we just did similar but around 3-month maturity. And that's an interesting result we obtained here. The increase in, again, combined capital charges was very significant for retail strategy. And one can see that for proprietary increase across all types of calculation is pretty small, but for retail it goes to 50–60%, which basically tells that banks which follow the strategy can manage some counterparty charges just by looking at concentration and at maturities. And just to go over again the results, so we showed that best performing methods are IMM for Basel II RWA and advanced for Basel III CVA VaR. That sophisticated Monte Carlo method, and obtaining regulatory approval saves significant amount of capital. We showed that Basel II CCR capital charges are not always lower than ones required by Basel III. We showed that impact of credit deterioration with credit spread doubled and counterparty downgraded one notch is bigger on IMM and advanced calculation, but still this combination gives the lowest total capital charge. And now to conclude this section, I pass microphone back to Aurelia.
Thank you, Dimitri. So Now we'll go through the result of a webinar. Also, as part of this, webinar, we will cover the key findings from a recent survey that we ran jointly Quantifi and Risk Dynamics, to provide a benchmark of the approach taken by market participants towards Basel III and the counterparty credit risk management in general. Over 80 traders and risk officers from leading global and regional banks were surveyed, half of who hold derivatives for client trading activities and the other half for ALM activity. So we'd like to share with you the result of the following questions. So, how prepared is your firm to meet the Basel III requirements? So, from a regulatory perspective, we observe that the market is not totally ready for this new regulatory requirement. This situation can be explained by the significant time investment and effort required to implement these new requirements, but also by the complexity of the regulation. It is indeed quite challenging to be compliant when regulation is constantly evolving with new technical standard reports or with new with consultative papers, the one I just presented before on the non-internal method model. So some clarification is necessary for some controverted areas of the regulation as well. But nevertheless, most of the respondents are confident in the preparation of Basel III requirements, as they are 86% to mention that they are in progress or close to completion of the new CCR Capital Charges. So if we go to the second result, question was, how is your firm managing CVA? From a business point of view, the CVA is generally managed by all respondents, but the way this management is embedded into the organization is more heterogeneous. Most of the respondents are centralizing the CVA into a trading desk or into a risk department. A significant number of respondents doesn't centralize CVA at all, but monitor and report it through other ways. Managing CVA in a centralized desk, in trading or in risk department, is considered to be the best way to have an integrated view of all risks surrounding derivatives and optimize counterparties and collateral management. I will give the floor to Dimitri in order to present the following results. Dimitri, it's up to you.
Thank you, Aurelia. Another question we asked, what do you consider to be the greatest challenge in satisfying the latest regulatory proposal regarding CCR? And from this graph, one can see immediately that by far the biggest portion of the biggest challenge is considered to be information and data management. And actually, first three biggest challenges are all related to technology, to data flow, to information, and that reflects the fact that challenge of data management and technology reflects the diversity of system within most firms and the challenge around integration and management of transaction, market, and reference data. And that also corresponds to our experience in dealing with data and technology for CCR purposes. If we go to the next slide, this question is, what do you consider to be the key components for an effective counterparty risk solution? And not surprising, data management again is the biggest key component, gets 75%. We already talked about this, but next is advanced analytics, which is also very important for counterparty risk management. As a quant for many years of experience, I can confirm that models required for counterparty risk management are probably the most advanced and most complex models, and you have to do everything right. You have to take wrong-way risk into account. You have to build all the market factors simultaneously. You have to run a very complex Monte Carlo based on many factors, so it's and then you have to price in this Monte Carlo all the trades, and some of the trades are exotic, which can be priced also only with Monte Carlo. So there are a lot of challenges here, and market participants put like pretty high importance, give very importance to advanced analytics. And other factors are asset class coverage and time of running and collateral management. So the conclusions here is that effective data management includes tools to simplify the integration process as well as tools for automating the ongoing management of this data. And measuring counterparty exposure presents significant computation challenges for accuracy, performance, and scalability. Models not only need to match industry best practice, they need to be transparent, easy to calibrate, high performance, and scale. And if we go to the last slide, which concludes this survey, we were asking, has your firm estimated the cost of CVA capital charge and Basel III? And if yes, then which method was used? There was no participants of the survey who said that they didn't do this or weren't planning to do this. 21% though still is planning but hadn't started. From among others, the prevailing is a standardized method or a combination of standardized and advanced. Only 13% for now are using advanced method, including stressed VaR on CVA. And the reason is that advanced method for CVA capital charges is relatively complex, and that explains that why only 33% of respondents developed this method and 21% haven't yet estimated the charge. And now I pass the mic back to Aurelie.
Yeah, thank you. So as a conclusion, we would like to present you the challenges and opportunities of the market for the short term, coming years, let's say. So through the survey, I would like to go on the conclusion. So from the survey, we determined areas related to the counterparty credit risk management where banks would need some specific support. So bank would need support for regulatory benchmark, as we have seen through the case study presented by Dimitri, that the choice of method for calculating the CCR capital charge has a significant impact depending on the type of business. Moreover, the regulation is constantly evolving. It is then difficult for a bank to ensure its compliance in such period. In terms of risk management, banks would need support in the integration of counterparty risk in their enterprise risk management. Indeed, market participants agree on the importance of an active management of CCR, jointly with funding, liquidity, and collateral management. In addition to this, banks would need support in the incorporation of the counterparty risk within the stress testing scenarios. And finally, in terms of performance, due to the current incoherences in the different regulatory frameworks, banks would need for support in the pricing and performance assessment of derivatives, combining the measures of CVA, FVA, and DVA. So for a final conclusion, we can summarize that even if the CCR started firstly essentially as a valuation issue, market participants slowly got ready with their compliance with the new regulatory constraints in capital requirement with regards to the counterparty risk. The current major challenge to finalize compliance programs lies in the implementation of the CCR framework into the existing organization. By implementation here has a broad meaning in the sense that in addition to the practical aspect of the implementation, the consistency between all different areas where CCR appears have also to be ensured. Furthermore, the selection of the most adequate approach to compute the CCR capital charge, so the standardized or advanced approach for CVA, for example, is also considered as a key challenge today. In fact, banks are attempted to be compliant at a lowest cost, but it has to be done by considering implementation and organization costs, and also by assessing the potential model risk, which is underlying the complexity of the models. And in particular, this point can be ensured through an effective validation of the models. So adopting an integrated approach for the CCR allows definitely to generate cost reduction. Moreover, regulation is continuously evolving, and it is quite challenging for companies to be prepared and compliant in time and with the lowest effort. For this, we believe that having a holistic internal framework for CCR that is fit for the users and the strategy of the company is the most stable and the best long-term objective they could set for themselves. So Dimitri and myself, we really thank you for your attention.